gives city opportunities to enhance returns and diversify globally. These sophisticated strategies demand expert insights. Leading this discussion is Mr. Brijesh Ved, EVP and Head of PMS at Kotak AMC, who brings over 20 years of experience across asset management, alternate investments and financial consulting. Having worked with ENAM, BNP Paribas and KPMG India, he has a deep understanding of managing risk while maximizing growth potential. Joining him will be Mr. Bheesham Rathi, a finance professional with 18 plus years of experience in sales, mutual fund distribution and advisory for corporate treasuries, family offices and trusts. Before joining ABSL, he played a key role at Man Financial Securities, promoting commodity and forex trading on international exchanges. He holds a master's in international business from Somaiya Institute of Management Research. Let's welcome Mr. Brijesh Ved, Mr. Bheesham Rathi and Mr. Aditya on the stage.
Thank you both of you for joining us today. And this is a topic which excites many people. There are individuals in the audience which are very experienced investors. They have been investing into sophisticated asset classes, product classes. But there are individuals who have not explored a lot of product classes apart from mutual funds. So that's why I would start with a very basic question. I would start with Bheesham. What is a PMS? What is an AIF? And how are they different from mutual funds in terms of product structure?
Thanks, Brijesh. Thanks a lot for giving us the opportunity to share our perspective on this. So PMS is portfolio management services, and AIF is alternate investment fund. The whole idea is basically, the way we evolve and all, we start looking at it somewhere that if I can have a luxury of, okay, so let's put it, AIF and PMS is like a, from the mutual fund perspective, it's a benchmark agnostic product. So if I look at the mutual fund, they have certain bindings, certain constraint that they have to have a long tail of the portfolio, that they have to, the theme, they have to align to that theme. They have certain constraint in terms of the benchmark hugging. The portfolio management should be benchmark hugging kind of a thing. Whereas when I look at the PMS, so PMS is like a customization to the code for the investor, depend upon his risk appetite, depend upon his kind of a holding period and all, we can design the product both on equity and debt. When I say AIF, somewhere it has a certain feature which is related, which is being borrowed from the mutual fund because it's a unit-based product. But parallelly, it has certain merits which is on the PMS side. That is, that it has a relatively concentrated portfolio than any of the mutual fund. So these are the two differences if I were to put across.
Yeah, thank you so much. And Brijesh, when we talk about AIFs, alternate investment funds, there are three categories of alternate investment funds. If you can explain what are these three categories, what kind of asset classes they invest into, and particularly in a category 3 AIF or a PMS, what does a fund manager can do differently than a mutual fund manager can or cannot do?
Sure. So first of all, thank you. Thanks for having me. Good afternoon to everyone. Just to explain in simple terms about the alternate investment fund. Three categories, as we know. Category 1, which essentially represents the entire venture capital opportunity. Now, as you know that a lot of large family offices, large investors do venture capitalists through their own family offices. But as an investors, when we want to kind of participate in companies at an early stage, the category 1 is one category which offers us this flexibility to essentially participate in early investing. So I think that's one of the primary kind of vehicle which is used in category 1. Apart of that, there are a lot of funds which are dedicated towards socio-economic purposes, etc., which also is categorized under category 1. Category 2 essentially represents multiple facets of AIF, including the credit funds, where if people or investors don't want to invest directly to a mutual fund group or to a bank group and want to have a little bit higher risk appetite when it comes to allocating their fixed income allocation. The credit funds come into play specifically in category 2. Apart of that, there are a lot of opportunities around structured products on real estate, etc., which will also come under category 2, where the fund manager will typically design a structure through NCDs and understand the businesses before investing on behalf of investors. Cat 3 is one which is actually scaled up quite a bit, and that's one of the most scalable product within the AIF so far is what we've observed. Now, category 3 essentially represents, and again for that particular category, the minimum ticket size being 1 crore as prescribed by the regulator, also brings in the investors who had experiences in the equity markets over a long period of time. It essentially represents two broader categories. One is long only, where it's a pure plain vanilla equity exposure that fund managers will take. The second category within the category 3, and these things are defined by the fund in the PPM when the fund is actually comes in for an offer, will be a long short. Now we have all heard about hedge funds, and when we talk about globally hedge funds, these are the funds which actually not only take a call on the market basis, being long on equities, but they also take calls wherever there are pockets of opportunity to short certain kind of sectors or specific companies. This long short category within the AIF essentially represents the hedge fund category, which is what globally it is known as popular. The other part of your question was on PMS. What he can within the, let's say, category 3 AIF, which is long only, as well as long short and PMS versus a mutual fund. I think the key difference in my view, of course, it depends on the mandate of each and every fund. But I think the broader difference in my view is the execution capability of the manager. So as we know that the moment we buy a mutual fund product, you essentially bought large part of the existing portfolio, plus incremental cash that we are contributing to the fund, which is where the incremental call is taken. As far as PMS is concerned, there is also a lot of customization possible. So while many of the managers do kind of look at modern portfolio, but to time a certain kind of exposure on behalf of our investors is pretty much possible in PMS. Let me give you a very simple example. Let's say if my number one position is an XYZ stock, which I'm very bullish on, and it's quoting at a certain price to earning multiple. When a new investor comes in, it pretty much gives us the flexibility within the portfolio management services structure to really kind of fine tune it, take a different weightage, do a little bit of customization. It doesn't mean that just because I'm holding it for my existing investors, let's say 10% position, I need to go ahead and buy 10% at the current market value. So I think that's the flexibility that PMS offers. As far as AIF is concerned, long short, as the name suggests, of course, gives the flexibility to short wherever the fund manager sees the opportunity. And long only again, a part of what have been the features of other funds. I think it also allows us to be a very, very concentrated kind of portfolio manager, which may not be possible given that mutual funds are extremely kind of open-ended most of the time, most of the schemes. I think these are some of the flexibility which will be available in PMS and AIF, which may not be available to us as a mutual fund manager.
Thank you so much. And my next question is to both. And as per my understanding, what I've seen across the industry, mutual funds are a more diversified approach. They take exposure into about 50-60 stocks, some even more than that. Whereas in alternate funds, PMS, AIF, they are a more focused approach. And for the last 4 years, we have seen a broad-based market rally. And particularly the funds who have been index having, they have outperformed, whereas whereas funds with very high active share, they have underperformed. So do you think that cycle would change or is changing, and it would be time for stock because market good fund managers would do really well, and fund managers who are not or just index having would underperform those fund managers who are doing a good job on the stock picking?
So I believe that whether it's mutual fund, whether it's PMS or an AIF, I think these are all vehicles, and we'll get into more details of whether it's either or and in terms of these vehicles from an investor perspective. But just to answer your question, I think world in general and markets have been quite volatile in recent time, or even otherwise we've seen post-COVID volatility plus the bull run that we saw for a couple of years. In my view, I think it's not about the structure, which is whether it's a vehicle, a mutual fund, or PMS or AIF. I think at certain times, certain strategies and certain investment philosophies of a certain house or fund manager works well in a certain market cycle. In certain market cycle where a lot of large caps do well, it doesn't really kind of typically outperform. Let's take an example. We all remember 2008, where there was this famous run about Rithik stocks, where 90% of the active managers underperformed because even within Nifty 50, there were these 5 stocks which led to 105% return, and everything else was either negative or it didn't contribute much. So I think a lot of these, whether it's active or passive outperforming, I think more than the fund manager strategy is also driven by the underlying market flows. Also, I must highlight to you that during 2018 there was a large amount of passive flows which happened to come into India from global investors as well, where Vanguard of the world, etc., who were investors in India for a very long time, had never seen the kind of flows that we saw in that year. So I think depending on the underlying market circumstances, depending on the investment philosophies of the fund house themselves, whether it's value, whether it's growth, would be largely kind of determining whether a certain fund outperformed during the market cycle at that phase more than the vehicles themselves.
Yeah, I think I will follow Gujarati say कि कोई भी धंधा चालू करने के लिए कम से कम 1000 किलोमीटर पड़ते हैं. So somewhere I will align the vehicle. Obviously, ultimately everything goes into the capital market, especially the equity market. So if you are giving a reasonable time and you are aligned with that, I think the performance will follow. And the country which we are talking, India, which has multiple advantages, not on the geopolitical side, but probably the demographic dividend and the stable government which has never happened in the last 70 years. I think all these things are somewhere giving us a really good green shoots that we are in one of the best time ever. So from that perspective, I think 3 to 5 years is an ideal horizon. If you stay in that with the discipline and align yourself with the fund manager strategy, which suits your need and all, I think it's the best place to be.
Thank you so much. And there are some real estate and credit risk funds in category 2. They come in category 2 AIFs. Both of your AMCs have come up with these products. What are the returns and the risk associated with these kind of funds, and what should an investor evaluate when exploring these options? Which is
so first let's understand, it's a kind of a word which a lot of people are talking about the private debt and private real estate and all. Let's understand the global perspective. So one, I think most of in the audience and probably including us, we are convinced that India is in one of the finest decade. From that perspective, you need capital. If you need capital, if you have to meet the $10 trillion economy and all, you need capital. Okay, that capital cannot be fueled by only the equity capital or the equity market. You need growth. Then if you go and try to check what happened in some of the developed economies, be it China, be it Japan, or for that matter, South Korea or Taiwan and all. So there the private debt to their GDP is roughly around upward of 150 or 160%. whereas India is standing at this point in time, it's only 55%. So if I club all those things that are growing, and if I had to align somewhere with these developed economies, that's what my dream is. So the money will not be supplied to that growth by only the equity capital. Okay, it has to come from the private debt. So that is one. Second, just think from a promoter point of view. Whenever he is, getting into some kind of a venture, or probably the existing promoter getting into a new line of a business, for him, the cost of equity is upward of 25 to 30%. Whereas on the other side, if he is okay with 15-20% or 15 to 18% into the cost, which helps him not to dilute the equity, which is very, very precious, which is very, very costly. So that is the second reason why a lot of these private credit funds nowadays has been talked about, or real estate funds has been talked about. Now, if you ask me what is the risk, I will say the risk which I can foresee at this point, and it's only the liquidity risk. So let's look at it, what happened in 2018 when there was a credit crisis, and some of the companies have not been able to meet. So the whole idea was, it was I'll say like a vehicle which was lending to some of the businesses which are on the growth stage, and they were not certain of the cash flows. They are certain that there is a growth happening. They are certain that there is a super opportunity available. They can bank on it. But the only thing is, it is about the timing and all. Okay? From that perspective, that fund was going through the mutual fund route, which is more like a open bus, where people can come anytime and get out anytime. So that was a mismatch. That's where somewhere the realization happened to an extent at regulatory level, at the at the financial consultant level, at the manufacturing level, that if we want to be part of the private credit story, if we want to be the part of the private credit industry and all, I think somewhere we need a different vehicle where we can have a like-minded investor who have the same kind of a risk appetite, who have the same kind of a holding capacity and all. And from their perspective, that's where the private credit or the real estate, come into the picture. And last 5 years, if I have to say, that industry has grown almost at a last 10 years, the growth from 1 million to around 11 crore of industry. And in next 5 years, it's expected to grow upward of a 30% CAGR, which will make it roughly around 20 lakh crore of industry.
I think just to add, I think from an investor's perspective, I believe that investors are always seeking something which was between a fixed deposit return and an equity return. So for example, if we say that long-term risk-free return would be, let's say 7-8%, and equity long-term would be 14-15%. There was a huge demand for or appetite for investors to have a product which would take enough risk but not as much risk as an equity, and generate a return of 11-12% or so over a longer period of time. That's more from an investor's perspective, and I think that's where the whole kind of demand environment comes from this kind of funds. From a perspective of supply, I think there are a lot of SMEs where while they do need liquidity and it's available over a longer period of time as they execute and as they deliver the scale, but they do need commitment from the supply side, which as my colleague mentioned here, which could be lasting for 3 to 5 years, because they cannot expect any kind of withdrawal during that phase when, let's say, they are going through an expansion of capacity, etc. So I think there was a nice kind of opportunity available, and I think essentially these funds are capturing that risk appetite as well as the demand.
Just one more point. Apart from this, I think somewhere that India on paper the inflation is around 5.5-6%. And if I look at it, current offering on the mutual fund space now, they were somewhere around 8.5-9% kind of thing. And if I look at it from a China point of view, the real retail is kind of a none to negative kind of a thing, where the interest rates falls somewhere around 5.5%. Whereas all these performing credit which offer around 3-16% kind of a thing at the investment level, if I look at it, it's kind of really a win-win situation. That's one more thing. And last but not the least is probably a regulatory point of view. If you look at it, there are a lot of regulatory development which has happened in the form of IBC, in the form of RERA, if I talk about real estate and all. that has somewhere, kind of protecting the end user, be it the investor or be the end consumer, I'll say interest also. So that is also kind of somewhere favoring a lot of these investors who are kind of trying to be part of this industry.
Thank you so much. My next question is for Brijesh. We have seen there are many boutique fund houses doing PMS, and they have been growing day by day. And you represent an institution promoting PMS. What can you do differently with compared with those boutique houses? What you can and cannot do compared with those PMSs?
So I think, firstly, in our industry, specifically on the business side, the barrier is extremely low. The capital requirement is extremely low. And we have more than, I think, 600 plus kind of providers. Unlike, let's say, if you look at mutual fund, where the capital requirement, etc., is way higher. I would say that some of my peers on the boutique side have done a phenomenal job, but I think over a longer period of time, I think what really counts, and in my experience in terms of equity management for over 2 decades, is the ability to manage risk. Because at times when these are good, markets are moving, what we really see is that a lot of those basic criteria are kind of missed out. Now, being a part of an institution, while it gives us the flexibility when it comes to PMS, to have that concentration, to have a portfolio of 20-25 stocks, but at the same time, we have a very robust kind of risk management framework, which overrules in case if we are kind of going overboard. So I think that's something which is very essential. The second, and the most basic part of our investment is always the research capability. Now, if you have a large base that you are managing, and most of the institutional houses have a shared research between our broader mutual fund platform and the PMS or the AIF platform. It gives you a much larger leeway to kind of play in terms of the universe, in terms of the corporate access, etc. So I think that those I would think would be the advantages. But of course, a lot of these advantages play over long-term periods of time during the entire cycle of play.
Thank you. Next question is for Bheesham. And everyone has heard about this word Gift City. So if you can explain what is Gift City and how is it helping Indians invest outside and also foreign nationals NRIs invest in Indian markets?
Thanks. I think Gift City, I'll say I'll say it's a new concept to India, but probably very known in the different part of the world, means sometimes Dubai, the Cayman Islands, and all these things. The whole idea is it's a lend, a foreign lend on Indian premises, which has no jurisdiction of India. That's how it is. The whole idea is that it comes with a when Mr. Modi was I'll say like a chief minister of Gujarat, and at that time they wanted to target these honest economies, especially Japan, South Korea, and all these. And from their perspective, they wanted an investment from that. And one of the things is that there are a lot of bureaucracy in Indian perspective, coming, and then you need a lot of approvals, checklists, and all these. So how can we, get away from that, and so that it become easy for the investor to be part of India growth story? And it got momentum 2018 onwards, when a lot of Indian. So one of the things which this government did is basically trying to go and get the voices of Indian diaspora. And keeping these two things in mind, I think Gift City is a platform where any foreign national or an NRI can be part of India growth story by investing through the route. And there are multiple options available for the investor on the equity as well as on the debt side. And he need not to be pay any kind of a tax, or not take much of the approval. Simply he can come, invest in India, and can get money back to the respective country. And the entire taxation will be on that country. Now when I say how can an Indian be a benefit? So as an Indian resident, we have a LRS limit where we want to remit money, and the purpose can be different. maybe a diversification point of view, maybe somebody is building a portfolio for the outs for foreign assets, or probably somebody who wants the money for his kid education and all, he can utilize that LRS limit where he can invest money, or probably he can own some of the foreign stocks in his portfolio for diversification point. So that's how these vehicles help investor diversification, as well as the foreigners to be part of India growth story.
Thank you so much. And there are so many words that goes around in the industry, and I want to just ask those questions to you guys. There's also a word called accredited investor. So, Brijesh, if you can help us understand what is accredited investor and what are the benefits for being an accredited investor, and how anyone can obtain it.
So I think with all due credits to our regulator, I think the whole concept of accredited investors has been started with this thought process that it's a class of investor who is well aware of the risks associated with certain kind of investments, and therefore if you look at the criteria which we kind of which we have for being registered as an accredited investor, include, for example, annual taxable income which needs to be kind of submitted for applying for that upwards of 2 crores, and a net worth criteria of 5 crores. Within that net worth, half of that net worth should be in financial assets, or if let's say an annual income of 1 crore with net worth criteria of 7.5 crores, half of that net worth coming into financial assets. And then of course, higher criteria for, corporate, which will be upwards of 50 crores. What it essentially gives is, a couple of advantages. One, of course, there are a lot of fund houses who launch a fund with specific criteria where, there will be a large ticket sizes involved. And therefore, they can get a higher allocation towards that if they are accredited investors. Because usually, it needs to be otherwise well distributed within the different investor class. Second is that, while not many people use it because, it's quite contradictory for the fact that, it's usually ultra high net worth individuals who will be kind of, getting this. But, it does allow you to invest in, let's say, certain structures like PMS for a ticket size or an AIF for a ticket size which can be lower than 1 crore. So you can have multiple kind of AIFs if you are an accredited investor, where you can participate for a lower usual ticket size, which is stipulated by the regulator, which is 1 crore. So I think in a sense, it gives a huge advantage to take higher risk. We have a structured products along with the respective fund houses to really kind of work on things where one is wanting to take higher risk, including some of the early angel investing that can happen from Cat1 and Cat2.
Thank you so much. And my last question to both of you. Can you describe some of the best practices that are deployed at your AMC, particularly when managing alternate investment funds, PMS, asset classes that are not very common?
So I think one of the things that we've been doing since last couple of years, and that's really helped us in terms of seeing a significant value creation for our clients, is really kind of sticking to a very rigorous kind of process that we follow in terms of research. So any company, for example, which becomes part of our portfolio, usually one always sees that when it comes to PMS and AIF, there is always this perception that it should be a micro cap or a small company with extremely high weightage. What we've done is we've divided our portfolios into 3 parts, and that's helping us a lot through that research process. Is that at all points in time we have a part of the portfolio sitting in stable compounders, and these are businesses which are extremely kind of immune to what can happen in economic scenario. For an example, an hospital business. Whether there are trade tariffs or whether there is a slowdown in economy, these businesses tend to continue to compound, given that we are quite underbed in terms of the number of beds available. Secondly, what we've done is as a second pillar, and which is helping us in our process, is that we tend to identify business, and our endeavor is to identify business early in the cycle. So there will be one part of the portfolio which will be sitting on emerging businesses, but these need not be very, very small companies. We typically come in with 300-400 crores plus of EBITDA in terms of size. And lastly, what we internally kind of learned and implemented is this whole thought process of buying business is cheap, which we traditionally call it as value investing, which is also inculcated. So largely we are growth at a reasonable price portfolio house. But when we speak about value within our team, and this is a kind of unsafe understanding within the research group, we don't look at anything which is a value if we don't see an inflection point. So for us, value is when we can identify the inflection point and we can see that there are certain events or there are certain things, whether it's change management, new product, things like that, that can help us discover the value should be part of the portfolio. Now with these three pillars on place and a very strong research backing, it's helping us to kind of really create value over long period. So I think simple things in terms of the process and thinking, but it helps a lot in terms of long-term value creation.
So for us, if I look at it, domestic AIF and PMS, which is long-on equity, we run on three broad principles. One, consistency matters rather than behavior. It's like nothing taking away the credit. Don't try to be a Alu Arjun and Tabata Pushpa, but try to be a Amitabh Bachchan with a consistency. So that is one. Second, I'll say look for a tax adjusted and risk adjusted return, because India is a market. If you play your cards right and you take care of the risk, I think return will banana. Because India in the global, if I look at it, it's only a market, country which is growing at a nominal GDP of 12.5%, 6% inflation and 6% GDP growth. So that's what we are talking. And if I add to 3% of our ROE, try to look at the company which is generating 15% plus kind of ROE, try to be part of those companies, and then add somewhere expertise of the fund manager that will kind of add to 3% more to it. That's what we are having. Now, when I say a risk adjusted, so for us the whole concept is don't try to be very, very concentration. Don't run the portfolio with an extreme concentration. Try to be a mutual fund plus kind of a thing. In the sense, if I look at the mutual fund broadly, 45 to 50 odd stocks is there in the portfolio. For us, it's somewhere 25 to 32% is how we run our domestic AIF and PMS. So that's the second thing. Third, try to be in the top 5 or top 10 holdings, try to be between 50%, not beyond that. So that is these are 2-3 things which help us to control the risk. Last but not least, I would say tax adjusted, because all these products, especially the AIF and PMS long-on equity, have a tax on the fund level, the fund level or the investor level. The whole idea is, if you keep the churn in control, you will give the real return or probably the tax adjusted return better to the investor. So for most of our portfolios, if you look at it, the churn is upward, lower than 0.5. That means that the average holding wherever we are getting, we are talking 2.5 to 3 years. So it's not that we only tell or preach our investor, but we follow that when we construct the portfolio. So that's more on the equity side, long-on equity. When I say debt, I think for us the whole concept is how can I add in my investor's portfolio a real return by 250 to 300 pips. Because the mutual fund universe ends somewhere 8.5 to 9% kind of a gross return and all. So we have a mutual fund plus kind of a product which starts from 10 to 11% with the investor in the money market fund, which is around 6 months to 1 year kind of investment horizon, and he can expect anywhere 50 to 100 pips over and above a mutual fund is given. Parallelly, if the investor has a little longer horizon, then I can look at it 40 to 60% kind of a return. With the clear-cut risk and compliance in place and all, and investor can expect somewhere around 250 to 300 pips kind of over and above real return in the portfolio. When I say a real estate, for us, the whole idea is, real estate broadly for us divided into the 4 broader buckets. A builder acquire a land, from there he takes a builder, and then launch a project, and in that project we start selling. So all these 4 concepts are probably 4 stages for any real estate project is there. So for us, we make sure that we enter when the land has been acquired, when the approval has been in place. We enter when the project has been launched, and we have to guard the risk more from whether that builder is putting money into that particular project, and is he able to sell that project in that particular market at all. So that's where we put our entire head, so that because these are the variables which we can control better. I'm not saying the other variable can't be controlled, but as a house, we are very clear where we want to play. And in that, we always get into the real estate once the project is approved, when the land is acquired. It's on the launch stage, or it has been launched. That's where we want to be part of that through a real estate offering.
Thank you so much. Thank you so much for your lovely insights. Any questions we have for the panel? Thank you so much, both of you, for joining us today.